We've got Gautam Duggad from Motilal Oswal to talk more about markets with us. Gautam, afternoon. Thank you so much for your time. Morning. Sorry, I'm already in afternoon mode, zoned
You're
out a
already
bit.
on Friday.
Yeah, looking forward to it. Gautam, you have a very wide universe of stocks which you track among all the brokerages, and it's only becoming wider as per the last discussion which we had. A lot of mid cap, small cap represented in your universe. This entire argument that small cap, mid cap rally so far was not broadly justified, and there was a frothy, valuations, earnings. What is the reality on earnings? What part of the small cap, mid caps are showing strength in earnings, and which part is actually falling back?
Hi, Ajay. Good morning. Thanks for having me. See, it's always very simplistic to paint the market or any segment of the market with one brush. You will find froth even in a bear market in some segment, and even in a bull market, you will find value in many segments. Secondly, when it comes to mid and small caps, Ajay, you've been in the market for a very long time. I think the one deciding factor always in mid and small caps specifically is the bottoms up thesis. You really cannot take a top down macro view, especially in mid caps and small caps. Right. So that is one point. Second, I do agree that valuations are expensive for mid and small caps, but it's not correct to say that the entire mid and small cap basket is frothy. Allow me to explain that. Mid cap index right now is trading at around 30% premium to Nifty. Nifty is trading at close to 19 and a half times 1 year forward now. And mid cap index is trading at somewhere about 27 times, which obviously is very expensive. Small caps are also trading at expensive valuation at an index level. Usually the average of small cap, if you look at the comparison versus Nifty on a 10-year basis, the long period discount is about 24%. Against that 24% discount, today it is trading at a 10% premium to large cap. So clearly, when you compare at an index level, and we use NSE mid cap 100 and NSE small cap 100 when we do comparison of these baskets. So on that basis, definitely things are expensive. Now, there are obviously some segments within mid and small caps where things have run way far ahead of themselves as far as fundamentals are concerned, right? Many of the industrial names, many of the PSU names, a few of them have the earnings and cash flow support. But that's the nature of the market. In any bull market, you will always find some things getting too expensive and frothy, and some things are always available where you can still justify. For example, if you look at the domestic cyclicals like hotels, real estate, some of the consumer discretionary names where the earning support is very strong, we still feel that those are spaces where money can be made. In fact, we just concluded our mid-cap conference this week, Monday and Tuesday. We had about 80 companies which were part of this conference. This is our 9th annual ideation conference. Across sectors, companies were represented, and we had about 60% of those companies being represented by CEOs. Now, the point is, given the recent correction in mid and small caps, we have seen huge interest in meeting those companies from the institutional investors side. So where you basically stand depends on where you sit. And when you look at the composition of the market, today you're talking about a 4.5, 4.6. I don't know the exact number right now because last 1 week things have changed. The total market cap in India presents a lot of opportunities at any given point of time for a bottoms-up investor.
Right. Gautam, quite interesting. Tell us a little bit more about the takeaways from the conference, and want to know about all the buzz and talk around PSUs because, some believe that it's getting frothy out there. But given that India is a decade-long story, I'm sure every correction is also a buying opportunity.
Yeah, Aisha, if you look at the last 10, 15 years in India, we have not seen any big durable market correction. Whatever episodes of market correction that we have seen, be it in 2013, 2018, and 2020, they were very short and swift, right? So it's always paid, at least so far it is paid in the last 10, 15 years to buy the dips and to invest for the long term. Now, as far as PSUs are concerned, I must tell you 2, 3 facts. PSU index of BSE was flattish for CY12 to CY21. That is almost 9 years. The total earnings pool in that 9 years was also flat. In fact, CY21 BSE aggregate earnings were down compared to CY12. Now you look at the current year. The current year, I think BSE PSU index is up somewhere close to 90%, if I'm not wrong. But look at the earnings pool of the entire PSU basket. If I look at FY18, the total earnings of PSU were about 80,000 crores, right? Which was the bottom in this cycle, right? From FY18 till FY23, the earnings went up from 80,000 crores to 3,80,000 crores. And the first 9 months of FY24 already 4 lakh crore of earnings have been delivered, right? As a consequence of that, the BSE PSU index P is still at 11 times. Now one can argue that the same P used to be 7-8 times and now it is 11 times. And of course, index P always is a bit misleading because it hides a lot of things, because there are too many companies in an index and some companies will be expensive, some will be cheaper. The point is, at an index level, if you see things when it comes to aggregate PSU basket, at 11p, I won't call it a bubble or a fraud. Now, whether there are some companies which have run too far ahead of themselves without any earnings support, the answer is yes. But are there still companies which are available at decent valuations, good dividend yield support, and decent earnings growth? Again, the answer is yes. So it's a very complicated kind of a situation where some companies are very expensive, even within PSUs. Some are still value buys. In fact, if you look at our model portfolio, you will find there are 5-6 PSU names. So you've been very positive on PSU banks for the last 2 years. We have the highest overweight on PSU banks in our model portfolio since April 2022. And still the banks that we have in our model portfolio are trading at 1 time and 1.2 time price to book, despite having doubled or tripled. And we think that the next 2 years, the earnings is still going to be very decent and healthy for the set of PSU banks that we have in our model portfolio. So, you have to dig deeper. You have to look at a lot of things, how the BSE, PSU, RE, the index ROE is looking at, how's the cash flow been. It's very simplistic to say that based on few stocks, the entire basket is frothy. I beg to differ there.
One clarification, quick one. When you say aggregate PSUs, you're talking about all the PSUs, metal, mining, power, PSU banks, everything into one, or you're talking about non-banking PSUs put together? Which
No,
index?
I'm taking everything.
Okay, and which index were you referring to? It is 11 after this kind of a performance on earnings?
Yeah, like I said, for 9 years earnings were flat. 9 years the index had done nothing. Its index has started doing well only in the last 12-18 months, while earnings has bottomed out in FY18. You can obviously dig deeper even there, and you will see that the incremental earnings between FY18 and 23, 50% of them came from a single sector, which is PSU banks. The next 30% came from metals and oil and gas. And then rest of the 20% from all other PSU sectors put together, which is utilities, defense, and everything else. So PSU bank cycle, which changed in FY18, in fact, the banking cycle itself changed in FY18. If you look at the Nifty financials, there were 11 financial companies in Nifty, and there are still 11, maybe 10 now after the merger of HDFC. If you look at the aggregate profit pool of these 11 companies back in FY18, in Nifty only, their profit used to be 45,000 crores. Now, as we are about to close FY24, they are at about 2.5 lakh crores. And next year, our expectation is that the only financials part of the Nifty, their total profits will be 3 lakh crores. Now, 3,40,000 crores was the profit of entire 50 Nifty companies in FY20. 5 years later, that is FY25, we are talking that just the 10 financial companies will have that 3 lakh crore of profit pool. So the profit picture, Ajay, in India has changed considerably. Without bothering you too much with numbers, but let me tell you one more number. FY20, the total profit of Motilal Oswal coverage universe was 4,28,000 crores. As we are about to close FY24, the total profit has moved to 11 lakh crores. So that's a 4-year earnings compounding of 27%. The equivalent number for Nifty 50 on a 4-year basis is 22%. You look at the performance of the index, it broadly tallies with the underlying earnings growth. Obviously, within the index, some sectors would have done better, some would have not done as good as others. But the point is, broadly, the market has respected the underlying earnings growth. When earnings are tepid for 10 years between FY10 to 20, the market was also tepid. You got 8.5% return in Nifty in that 10-year period when earnings compounded at just 6.5%. Last 4 years, earnings have done well, so markets have also done well.
Gautam, what is the outlook when it comes to the IT space? Does that cautious stance still continue to remain due to large uncertainties? And in light of that, if so, would the strategy be to look at a mix of large and mid caps, or would you stick to just the large?
So as far as IT is concerned, we are running an underweight stance in our model portfolio. While the stocks have underperformed, especially the large caps, because if you look at the prices of some of the large caps today, they're still trailing the prices that they had in October 21. Now, with Accenture's guidance yesterday and commentary, I think the softness can continue to prevail and you might see a little more earnings downgrade. Expectations are quite moderate there. It's not as if that people are expecting heaven from IT in FY25. Our preference within our overall underweight stance is still with large cap because we find slightly better risk reward value proposition in large cap IT versus mid cap IT.
Gautam, I just want to go back to the point that you were making earlier, right? That there is still value in PSUs. Ex-banks, would you say that now the next leg in PSUs is going to be a little tougher? You got to do a little bit of homework. It may not be a broad sectoral move, but there will be individual stocks which will have value as well as growth coupled with them. And if so, have you identified such opportunities and could you highlight any?
So, Aisha, it's a cliche thing to say that you always have to look at bottoms up, you have to be stock specific. I mean, in every market condition, you have to be very stock specific and bottoms up. And today's market is no different. Obviously, as you rightly said, within PSUs, there are many segments, many sectors. As far as our stance is concerned, if you look at our model portfolio, we have SBI and Bank of Baroda in our model portfolio for a fairly long period of time, and we still continue to find value there. We hold HPCL, GAIL, and Coal India in our model portfolio. So there is a heavy representation of PSU basket in our model portfolio for some time now. There are individual stocks these are individual stocks where we find value from a point of view of earnings, from a point of view of valuations and dividend yields. As far as the broader market PSU is concerned, obviously things have done exceedingly well. There will obviously be some stocks where earnings might not have grown, but stocks are up 3x, 4x. Now, those are the segments you have to be very cautious about. So, like I said in the beginning, you cannot have a broad brush approach. You have to be, selective, and you have to keep an eye on earnings and, of course, the valuations. And that's why we are having a view that as a basket, when you look at aggregate, PSU still represents value. And when you look at our model portfolio, there is a representation of PSU in various sectors in our model portfolio.
Before I let you go, just go back on that point you referred to. You represented, there were 80 companies, representatives coming in and presenting their case and business, etc. Can you name a few of the companies where you expect, or sectors or representation from those places where earnings growth is likely to be higher than 20% in the next 3-4 years? That
so
is the
Ajay,
kind of visibility.
Many of those 80 companies that participated in our conference, we don't have a coverage. So I'm afraid I cannot talk on their earnings growth potential. It's fair to say that large part of the basket that we like from the companies which participated in our conference are part of 3 different sectors broadly. One is consumer discretionary, which is where we anyways have a very positive stance. If you look at our model portfolio, we hold 8 consumer stocks, out of which 7 are discretionary in nature. There's just one staple. Second, hotels. We feel that hotels as a sector has a long way to go. The cycle is just about started 2 years back, and it has gone through a 10-year of a down cycle. So we still find a lot of value in hotel sector. We think that the underlying operating fundamentals are still very strong, and the demand supply dynamics are very favorable. And more or less, we have a similar view on real estate, which has also gone through a fairly long period of a down cycle from 2008-9 to almost 2021. Last 2 years again have been good, and we think that the durability of the cycle in real estate can be higher than what we have seen in the past, which is why we have a very significant overweight position on real estate in our model portfolio. Versus the benchmark weight of 0%, we have almost 4% allocation to real estate. So those are 3-4 sectors which I feel, which were also part of our conference, and which is where we also have our analyst team likes those sectors.
Okay, Gautam, always a pleasure chatting with you. Thanks so much for joining in and sharing with us your outlook on the overall markets and what the sense is as well when it comes to the broader markets versus the frontliners. A quick status check as to what we're up to right now, and down 0.5%.
If you like this video, then like, share and subscribe to ET Now.